Hi, I'm Russ Christensen. I'm a co-op developer. I'm here on behalf of the Canadian Worker Co-op Federation's Worker Co-op Academy. We're here to help people start and launch their own worker co-op enterprises. Today we're going to be talking about financial statements and how to understand the story that they tell about your business. Finances are just one part of a triple bottom line. Triple bottom line includes the social or relational aspects of the business, the ecological or environmental aspects, and the financial or economic aspects. So today, we're going to focus on the financial aspects. As a worker-owned business, all the members of the worker co-op should be able to read and understand the financial statements from the co-op. And they should be able to understand what contribution or impact they're making on the business through their day-to-day work that they're doing in the co-op. Now, reading financial statements is not hard. It's just that we're not taught how to read financial statements in school. We probably should be. It's really a basic skill. Anyone can do it. And the financial statements, the best way to think about it is the story that they tell about your business. So let's start with the income statement. The income statement is my favorite financial statement. It shows the flow of money through the business. So money that comes in and money that goes out through the business. So let's take a look and start at the top on the income statement. We've got sales revenue at the top of $8.1 million. We have cost of goods sold at $5.5 million. And the resulting gross margin, which is the cost of goods sold, taken away or subtracted from the sales revenue, is $2.6 million. That's a pretty healthy margin at 32% of the sales revenue. The expenses for the business, which includes salaries and insurance and telephone and internet and travel and advertising costs, is $2.1 million. So the bottom line, or the net income, is $453,000, or 5.6% of the total sales revenue. That's a pretty healthy net income for this business. This is a fair trade worker cooperative in Canada that's been in business for many years, and they seem to be doing all right. Now, the wages and benefits are $600,000, which represents 7.4% of the total sales revenue. And the ratio of the highest to the lowest paid is 2-to-1. That's a great ratio for a worker co-op, especially when you can compare it to large corporations in Canada that often have a 400-to-1 ratio of highest to lowest paid worker. Now, the other statement, financial statement to look at, is the balance sheet. The balance sheet is just what it says. It has to balance. In other words, the assets have to equal the liabilities plus the owner's equity. Let's take a look at the balance sheet. The assets include current assets such as cash in the bank, the accounts receivable, the inventory that the business has, and the prepaid expenses, which could be things such as insurance. The total current assets for this business are $3 million. Under that, you see the liabilities members' equity. There's bank indebtedness, so there's loan indebtedness. There's an accounts payable amount of $687,000. That's an amount that's owed to suppliers that finances the inventory of the business. And then there's a small amount, current portion of long-term debt. The term loan is for $120,000, and that's being paid down quite well. So the total liabilities are $964,000. Below that, we have share capital in members' equity of $1.3 million, a contributed surplus from previous year of $15,000, opening retained earnings of $354,000, and a net surplus, which is the income or profit from this year, of $453,000. So the members' equity together with the liabilities equals $3.1 million, which is the same amount as the total assets. So the balance sheet balances. Now, an important thing to do, and it's probably the single most important thing to do in terms of your financial system in your co-op, is to compare the actual results of your co-op with your budget. And you should do this either monthly or quarterly, and you should definitely do it annually. So when you compare it, let's look at the variance analysis for this worker co-op. Again, we have actual sales of $8.1 million. The budget was 8.6, so there's a variance of $500,000. So that's an unfavorable variance. That's what the U is. The cost of goods sold is $5.5 million. The budget was $5.8. That's because the sales in the budget were higher. So there's a variance of $300,000 in cost of goods sold. That's a favorable variance. In other words, it's better than the budget. So the resulting gross margin is $2.6 million versus the budget of $2.8. That's an unfavorable variance because they had budgeted for a higher margin than what they actually achieved. And you can see that the percentage of sales at 32% in the actual versus the 32.4 is lower. The actual is lower than the budget. In the expenses, we've got budgeted expenses of $2.4 million. The expenses were well controlled and came in at $2.15, so that's very positive, and that resulted in a favorable variance of $244,000, resulting in a net income of $453,000, which is above their budget. So overall, the story is this is a healthy co-op with pretty strong financial statements. Thanks for participating in the Canadian Worker Co-op Federation's Worker Co-op Academy. We suggest that you watch these videos more than once if you need to, and take some notes and write down some questions.